Stocks closing higher after cooler than expected CPI print. Core CPI up just 0.2% versus last month. That's what our next guest was counting on when he predicted a 100-point gain for the S&P 500 this week. Joining us now is Tom Lee, Fundstrat's managing partner and head of research. Credit where it's due, Tom. It's unfolding much as you said, but you have a 48.25 year-end target, I believe, for the S&P 500. That's another 355 points, 7.5%. What else has to go right for us to get there?
John, a few things definitely have to go right. One of them is that inflationary pressures need to sort of be cooling that in a way that we saw in the June CPI report. And we're pretty confident like a 0.2 core could be seen for July and August. So I think it's repeatable. The second is that I think the Fed has to sort of start to accept that this is indeed a breakdown of inflationary pressures. And so they may potentially then reduce their notion of higher for longer, or the market begins to price it in. And that's not a guarantee. But again, we believe that's the case, especially because this is pointed to core being, in the 3% range within a year. And the third is that investors really have to believe this because, as you know, many believe a recession is imminent. And I think earnings season will really give us an idea. We'll know that in the next couple of weeks. But if a recession is not imminent, then I think a lot of folks are off sides. And I think that's what helps propel markets to all-time highs.
Okay, so it sounds like you're saying that you need 0.2 core for July and August. Fed needs to relax higher for longer, and yet we need to not be in a recession, which if we were heading into a recession, that would be a reason for the Fed to cut. So that's a lot to go right.
Yeah, you're right. The Fed's trying to navigate a really difficult path that I think people assigned almost no probability to, which was a soft landing. But now it looks like they've achieved a soft landing because they telegraphed, a massive increase in hikes last year. When Fed funds was, under 100 basis points, they said they were going to be aggressive. Businesses got cautious. So we don't necessarily have companies tripping over themselves, which is what typically creates the recession dynamic. But at the same time, we can't have inflation linger and burning and then flare up again. Fortunately, consumers aren't expecting that. But I think that the Fed can actually sort of breathe a little easier because the economy hasn't been destroyed.
So is your expectation, Tom, that we're going to see another 25 basis points at the end of this month, and then maybe that's it?
Well, yes, I think July, for credibility's sake, they have to follow through with that hike. There may be one more because they committed to that. But one thing viewers have to keep in mind is that last year the market endured 500 basis points worth of hikes. This year, we only have another 50 in front of us. It's a lot less damage to the system, of which, that of 25 may not happen. I think either way, if it happens, I think we can still see earnings grow and get to all-time highs, actually.